Hi, it's Griggs with Obsidian Wisdom. Today we answer the question, how do the interest rates impact my retirement plan? When it comes to these changing interest rates, currently in the environment, the interest rates have gone down. And there are concern or at least thoughts that the interest rates are going to continue to go down as we try to battle away this idea of going into a recession. And so the question ultimately is, all right, Dre, what should I be doing with my retirement investments? And so for this one, I'm really is really a balance of understanding what humans normally do to understand what we should then do next. And the way I would have you think about this is there really isn't an environment where everyone loses, right? There is a choice, there is a strategy, an approach that can ensure that someone wins in every economic climate. That even if you take the worst economic environment, such as the Great Depression, that everyone didn't lose their money in the Great Depression. Everyone does not lose their money in Great Recession. That there are people who make more money than they've ever made in their entire life. So if you have that in the back of your mind, as we go through these different approaches, I really want to drive home the idea that, hey, look, I don't know which one of these, if any of them, would make sense for you because I don't know when you're going to retire, your risk tolerance, and all these different things. But what I am saying is these are some strategies that can work for the right situation and the right person. So first, let's go through some of the approaches. So it's important to remember when interest rates go down or interest rates go up, that it has a positive or negative effect on some of our investments. And so let's go through each of the asset classes that I generally focus on when we talk about creating those three streams of income because 65% of self-made millionaires have at least three streams of income. And with that information, I know that out of the seven streams of income that are available, that we need to find the three that makes the most sense for your retirement. And they're normally going to be access to three asset classes. Number one is the stock market. Number two is investing in a business. And number three is investing in real estate. If you have your money in one of those three asset classes, you generally have access to all of the seven streams of income that the IRS says they recognize. So when it comes to a business, if you are someone who either wants to run a business in retirement, you are already running a business and you're heading into retirement, or you're someone who's been thinking about buying a business in retirement, something that is a hobby that is of interest to you, then you are excited when the interest rates are decreasing. Because when the interest rates decrease, that means I'm able to borrow more money and I'm able to have a lower monthly payment. Because what you'll see is your overall monthly payment is tied to these different indexes, these different interest rates, and they're tied to wherever the Fed sets the rate at. So as the rates go down, the interest rates that these banks are offering also go down. And so now you will see that I'm able to receive more money with less monthly payment. There's a couple things that we could do with that. Some people like to buy houses, some people want to take more trips and different things like that. But if you're someone who's interested in purchasing a business or growing a business, that could be a very rich opportunity for you. Let's say if you're able to go secure a $100,000 to $500,000 loan, that interest rate is going to be lower than what it would have been when the interest rates were at all-time highs because we're trying to battle off inflation. As a result, if you're able to get a loan for, let's say, 4%, that all that means is you have to return more than 4% on your investment for that to make sense. And more times than not, if you're investing in a business, you are going to have more than a 4% margin. And so whether or not you are someone who just wants to interact with people, like I've seen down the street, there's a retired lady who had purchased a ice cream shop. And you could tell she just likes kids and hanging out with people. And so she just hangs out there all day and talks to people. That works for her. I've seen people who won a vineyard and they go buy a bunch of land and they run their vineyard. And you're able to kind of build these hobbies that generate an income for you in retirement. And that is an opportunity that's available as long as you're able to generate a return that's higher than the interest rate that you are paying for the money. And that becomes much easier when the interest rates go down. So that is definitely an option for you. And also from an interest rate perspective, as the interest rates continue to go down, that normally makes it much easier for your business to succeed. There's normally more access to money. And when there's more access to money, people are going to spend more money. Well, where are they going to spend the money? They're going to spend it with the businesses that are offering the services that they want. And so normally it becomes very easy for a business to make money, which leads us very nicely into number two, which is investing in the stock market. Normally when interest rates go down, you'll see historically speaking, the stock market performs very well because of what we just mentioned. If money is easy for me to access, and as a business, my margins are normally higher than the rates the banks are offering me, then that means I almost can print money where I'm able to say every $1 I borrow, I can make $3 from a business. And because a lot of businesses are very successful, that ends up floating the entire stock market, where we're able to see as a whole the stock market rise, where we reach new highs. That is a great opportunity for us to sometimes make a shift in our investment strategy where maybe we weren't invested that much in equities, but we don't have to go with the risky ones. I'm not telling you to go buy some cryptocurrency or like metaverse or something that's kind of on the future edge of things. But what I am saying is maybe you can invest in some blue chip dividend paying stocks. And so now, because as the interest rates go down, you and I will get into a little bit further when we talk about the overall interest rates and the impact on your bonds and debt. So sometimes we have to start deciding, where am I going to keep my money if I'm worried about having this negative impact and not being able to reinvest in some of these bonds and debts as the interest rates keep going down. Because you remember back in the day when it was like 1% is what they're paying, at 0.5% is what they're paying, because the interest rates were down to almost 0%. Now, I don't think we're going to go back to that because the environment is not as bad as it was after the Great Recession. But I am someone who thinks that they're going to lower the interest rates again. That I don't think it's going to be a one-time thing. That's just not what the normal recipe is. Because if I only had to lower the rates one time, then most likely the Fed wouldn't have lowered the rates at all. They generally only take action when it's very clear that we're either going into a recession or a depression or the inflation and different things, where there are certain things that they just want to keep track of. And if they felt that they needed to lower the rates a 0.5 percentage point, then it's very clear to me that they know that we are going into a deep recession. And as a result, they had to make that change, which ultimately means that they don't know how much the next rate cut should be, but they know that they probably need multiple rate cuts, right? That's just obviously my opinion. I'm not sitting there in the Fed meeting, but that's just generally the way that they've done things. So that might mean that you have to get off of some of these bonds. I believe that blue chip, which is going to be very large, stable companies, probably not going anywhere. So you're not risking a lot of your retirement funds, but then you focus on the dividends, where they're going to be able to take advantage of this basically free money, and they're going to be able to grow their companies and expand their research and development and bring new amazing products into the market. As a result, if I'm investing in these companies and they're just going to pay me dividends, that could be a strategy to offset some of those bonds as you start losing some of the income that you were receiving. And when we move into the bonds, the reason that lowering the interest rate has that negative impact is it has an inverse relationship. And the idea is, if I was able to get a 6% bond, a 6% savings account, a 6% CD in January, and all of a sudden you lower the interest rates, now you're offering me a 5% CD, a 4.5% savings account. I have two choices, right? Obviously, choice number one is I buy that. I'm like, all right, well, it is what it is. 4.5, 5%. That's still good. That still works for my retirement plan. The other option is you say, hey, that other person got 6% in January. Maybe I can offer them a little bit more to get them to sell it to me. And so now all of a sudden, because of the inverse relationship, when interest rates go down, you'll see that your bond value go up. And the reason your bond values go up is because you're holding the bonds at a rate that no one can get in today's market. So you have the scarce item. And because of that, people are willing to pay a premium. If you're someone who doesn't have the ability to purchase a business, or you're not someone who is very comfortable investing in the stock market and blue chip companies, or whatever the other strategies that you could possibly implement, then that means that you're like, hey, look, I'm focusing on bonds. And as a result, if there's someone out there with a 6% bond, you're going to have to offer them more than what the market is offering today and more than what they paid, because you can't find a 6% today. And it's very likely that the number is going to continue going down. And so you end up having this opportunity where, if you are someone who has built some bonds, where you either had a bond ladder or you just had bought a significant amount of bonds, to where you have a good investment strategy where you're already holding on to 5-6%, well, you might just be able to hold on to it. But if you are enticed because people are going to offer you more than what you paid for it, you might be interested in selling your bonds. And when you do sell your bonds, you're going to receive a premium of income. But obviously, you can't go back and buy the bonds. I mean, technically you could, but you will be buying the bonds at a lower interest rate than what you've been receiving, where you had 5, 6, 7% bonds because of the higher rates for getting rid of the inflation. And now you're going to be receiving that 4 or 5% return. But then as the interest rates keep getting cut, the number keeps getting lower. So you may have a 3% bond in the near future. As a result, you are someone that's going to have to make a decision. That's why a lot of people like bond ladders, which is a very fancy way of saying that you normally just stagger the interest rate, you stagger the duration of them, how long they are, where you have some short term, some medium term, some long term bonds, which short term is like under a year, medium term is, let's say like 5 years, and then long term is anything over 10 years. So you'll normally have this bond ladder where you're able to spread out that risk. But keep in mind that inverse relationship between the bonds and the interest rates means that whenever the Fed feels like we're getting back into that inflationary environment, that means they're going to start raising interest rates again. And if they raise the interest rates, then that ends up decreasing the value of your bond, because now the opposite is happening where you have all these bonds in the old market that was at 3 to 5%, and the bond of today is at that 6 to 7%. Well, of course, everybody is going to be buying the bond of today. Your bond of yesterday is almost going to be almost impossible to sell, where you may have to give people more than what you paid for it to get them to sell it for that income, which is naturally not what we want in our retirement plan. But that is a real thing that you have to consider, that if you're invested heavily in the bond market, then you're well aware that there's a point in time in your retirement where the bond's going to be getting less than 3%, barely keeping up with inflation. But there's another point of your retirement where the bond's going to be almost the exact same as the stock market, where you're literally having a risk-free return equal to the risk of the stock market. And so I completely understand it, because both of those do happen, and they will, because most of you are going to be retired for longer than 10 years. That normally means that you're going to be dealing with at least one recession in your retirement. And because of that, the Fed is going to be adjusting those rates. And so you do want to have a plan in place, whether you ride out the bonds because you have a bond ladder, as we mentioned, or whether you shift into some assets that perform very well in those times when the interest rates are lowering, to where you can kind of leave the bond market, but you're not taking on a significant amount of risk. Obviously, you're taking on more risk than a guaranteed return of a bond, but you're not taking on the risk that is uncomfortable, something that you are risking your actual retirement savings, but you have a full strategy in place. Now, for those of you that have an annuity, that underlying return that you are given in your annuity, that does fluctuate, where there's normally a floor and a ceiling, but whatever the overall rate return that you have is, it's tied to one of these indexes. So for most of you, that payout is going to fluctuate based on whether the interest rates are up or down. And so in this current environment where interest rates are decreasing, that means that your payout in your annuity is also decreasing. Because remember, at the end of the day, if you have a standard fixed annuity, that amount is tied to them investing in relatively safe investments. So they're going to be investing that money in CDs and money market accounts and other short-term investments. Well, you and I just talked about that. We know that as interest rates decrease, that the amount of money I receive for my CDs and my savings account and just cash in general, that number is also decreasing. That's the same for the insurance companies. So they're going to lower how much they guarantee your return to be as interest rates decrease on your annuity. So your payout on your annuity might have been a guaranteed 3.5%, let's say something like that. As the rates go down, you're going to start seeing that the guaranteed payout is going to decrease to maybe 2.5%. And then whatever inside of the fine print of your annuity, wherever they're allowed to decrease their guaranteed payout for you, if they're allowed to do that, they are going to do that with the interest rates decreasing. Because in their mind, we're not getting that much of a return. So we're not just going to keep promising to give you a high return. We're going to adjust how much you receive. Now, there's always fine print. You can add all these riders where you have like guaranteed inflation adjustments and long-term insurance and different things like that. But what we are saying is just high level, that your annuity payout is going to decrease as the interest rates decrease. And then if the interest rates were to increase, then your annuity payout would also generally increase. So when it comes to the strategies that you can implement in your retirement plan when you're dealing with these fluctuating interest rates, the first one actually is diversifying. We already know that there's going to be assets that perform very well when interest rates go down, such as businesses, the stock market, and real estate. We know that there's assets that don't perform very well when interest rates go down, such as CDs, money markets, cash, and other fixed assets like bonds. So we can have an adjustment in the weight of our asset allocation. Next, as we mentioned, you could also consider other income producing assets, whether you want to just invest in blue chip companies focusing on dividend returns, or whether you just want to overall look at dividends. And I'll put a link to a video where I go through some dividend strategies as far as choosing which ones to invest in. that is definitely an opportunity that's available for you as well, where you replace some of these bonds that you're focusing on income and you invest instead in other income producing assets that perform very well when interest rates are lower. If you're someone that's heavily invested in bonds where you're just not sure that you can offload that much of your position, where you're not sure that you want to buy a business or invest in the stock market and focus on dividends and other income producing strategies, then normally what you do if you're heavily invested in bonds is you normally start looking at shortening the duration of some of your bonds instead of it being 20 or 30 years, because the interest rate changes is going to significantly affect the long term. As you can imagine, if you were someone in 2020 who got a 30-year bond at like 3%, and then you go to 2023 and all of a sudden they're at like 6%, that would almost destroy your 20-year bond, where you'd almost have to give it away to be able to trade it in at that particular time. So a lot of the times it's better just to have the short-term durations because it makes it a little bit steadier, where you're basically always updating with the market on a 1 to 2 to 3 year basis. And so that ends up getting rid of a lot of that heartburn as you're watching the fluctuations in the markets from interest rate peaks and interest rate drops. And the last strategy that might be worth implementing in your retirement plan is just locking in some of these current interest rates. If you're someone who believes that the interest rates are going to go even lower, that means that the rates that you can lock in right now are going to be a premium in 6 months. That even though it is lower than it was in January, where you're at now is going to be better than it's going to be in 2025. And if you are someone who believes that, then buying up or investing heavily in the bonds at the current rates could be a strategy where you're able to lock in a number that works for you. To where even though it's not that 6, 7, 8%, I'm able to lock in a 4%. And you know what? A 4% return works for me. I'm like, hey, cool. If that works for you, you like it, I love it. As we mentioned earlier, the goal is to have at least 3 streams of income, because we know that 65% of self-made millionaires have at least 3 streams. Those streams can change depending on the economic environment. That in times of high interest rates, I can use interest income and I'll be fine. The bank's going to give me a 6% return. But then when interest rates start going down, maybe I need to switch to investment income, which is dividend streams, or rental income for my real estate, which is still equally fine. I just need to have a plan in place and a strategy that allows me to ebb and flow with the market. Now, for someone who's not very interested in keeping up with this stuff, you really have 2 choices. One is you could obviously just diversify. If you diversify enough, you can have where a portion of your portfolio performs well, and then a portion of your portfolio doesn't perform well in every environment. You just have a portion that's winning and a portion that's losing. And that's okay because you're going to have the average return that you need. And that works. That is a set it and forget it strategy that works for a lot of people. Number two is you can obviously reach out to a professional. And if that is something that you're interested in, I'm always here for you. And I can help you put a plan in place, an investment strategy in place that allows you to feel comfortable and peace of mind when you're dealing with the market volatility, to ensure that you're able to maintain your retirement income, not for money's sake, but for your retirement's sake. You have goals and there's a number assigned to those goals, and happiness is tied to how you spend your time. If you spend more of your time doing things that bring you pleasure and purpose, then I'm feeling really good about how you're going to feel about retirement. If I can help you in any way, feel free to always reach out to me. You can go to obsidianwisdom.com. Until next time, stay safe and enjoy life.